I'm really excited to be joined by Vinay Agarwal for the second interview of this investor series. Vinay is a director at First States to Asia and manages funds in India and Southeast Asia. He's also worked at Arizag, and I think it'll come across that in the interview as well, probably, that he has a focus on the Indian subcontinent. Um, I actually spent a couple weeks at First States towards Singapore over the summer. I was very lucky to be able to observe the way they operate and how they and sort of learn from how they think about a company. Um, and I guess in the last 2 years of reading how different great investors, so to say, think about companies, and also speaking to different investors, and in the observation I did, I am, I guess, getting exposed to different investment philosophies, and I'm hopeful that I will be able to develop my own philosophy by learning from these different philosophies and sort of creating a melange of those. And I guess in that spirit, I hope that you can learn something from Vinay's investment philosophy as well. Start, I was thinking we could perhaps begin by discussing how you developed your interest in investing, or maybe even when you began to get interested in investing.
It's hard to pinpoint one moment which changed that for me. Um, but I think while I was growing up and when I was studying, my brothers have had a big impact on sort of choices that I have made in my career. Um, and after I finished my post graduation, um, I used to sort of hear my brothers talk about one of my brothers was in sort of financial services, and the elder brother was in consulting, but obviously he was interested in stock market. So I used to hear them talking about it, and that sort of I was always interested in it, just listening them talk about it. And also while I was doing my post graduation, I used to sort of play these stock market games online.
Okay.
Not understanding much, I did not understand how to analyze companies, but I just I had a sort of a fascination about what makes people, how is sort of price determined of a company on a daily basis, and why does it move every day. I that was the only basic sort of curiosity to begin with. And then I remember when I very it was by chance that I got into investment management industry.
Okay.
In 2003, when I joined a company called Arizek Partners.
Okay.
And I just instantly I started enjoying doing what I was doing. It's like when you play a sport and you find your sport that you're good at, or you enjoy. I'm not saying good at, but you enjoy doing, and that's what I liked. And another point which I remember very distinctly is my brother. He gave me a book called Money Masters of a Time.
Okay.
By John Tray. And at the same time, I don't remember exactly whether it was before I joined RSI, but just immediately after I joined RSI. And when I read that book, it was about there were 16 or 17 chapters, each chapter about a particular investor.
Okay.
And their investing style and what they have done in their career. And when I read that book, I just thought it is fantastic. And there are so many different ways of investing, and all these guys have been successful.
Mm-hmm.
So my sort of that
sort of drew you in.
Yeah, drew me in.
Okay. I guess that leads us very nicely on to, there are so many different ways of investing, and different people do different things successfully. So, sort of, what is your investment philosophy, and how do you think about investing in a company?
So I can tell you what are the things that I look for in a company. And over the last 16 years that I've been doing this, I think it has evolved to this, I think, and probably it will keep evolving as I continue. There are 3 or 4 things which are most important to me.
Okay.
The first thing is the quality of management
Okay.
of a business. Sort of, I spend a lot of time sort of looking at who owns the business, what is their background, how did they start the business, and how the business has evolved over time, and what are the decisions that they took during that period. What are the capital allocation decisions that they took during, in cyclical upturns or downturns? Have there been any periods of sort of misallocation of capital? Have there been any periods of sort of corporate governance mishaps where they have, sort of shafted minority shareholders or even other stakeholders, not just minority shareholders? I believe sort of good quality management or good corporate governance is sort of owners and management team thinking long term and thinking long term in the interest of all stakeholders.
Okay.
And not just shareholders.
Okay.
And it could be taxman, it could be the employees, it could be the community around them, it could be also the environment, how they affect the environment or the climate in which they work. And if they are sort of shortchanging any of the stakeholders in running their business, that makes me wonder what are my chances as a minority shareholder that they'll take care of me in the long term.
Okay.
So alignment of interest,
So
not just in terms of sort of economics, but also sort of culturally, whether
Okay.
I can feel aligned in what they are doing, trying to do in the long term is very, very important to me. So I won't also invest in businesses that I don't sort of believe in, or not just on ethical grounds, but I believe that there is an unlimited risk of losing capital with businesses like sort of tobacco or gaming companies or businesses which are involved in manufacturing of weapons of mass destruction. I won't invest in those sort of businesses ever. Businesses which are built on corruption, where the owners have got license to operate by way of corruption, and they sort of change regulations to suit them, so that they can earn as an excess return on capital, is something which I'm not comfortable with, and I won't ever invest in people like those or companies like those, no matter how attractive the valuations or growth opportunity might become for them. The value of those businesses in my mind is zero. So I'm always sort of excluding companies based on corporate governance, and sort of thereby sort of restricting
the pool.
the universe that I want to look at, which makes it easier in a way. So that's number one. Sorry for the long answer. Other thing. The second thing that I look for is quality of franchise. So if something is, if I like quality of people that I'm backing, that is most important. Then I look at the quality of franchise. And what do I mean by that is sort of if in one financial ratio which sort of is all encompassing and covers the basic essential characteristics of a quality franchise, I think is return on capital employed, in the longer term return on capital employed. And I spend a little bit of time in understanding what drives a return on capital employed for a particular business, and to look at sort of long-term trend as well. Okay, whether it's their profitability, whether it's margins, whether it's sort of their asset turnover ratios, and they are, if a particular business or management team is more efficient in sweating their assets than other companies, and why is that? And understanding whether that is a sustainable advantage or not. Same with margins. What is it which gives a company the right to earn higher profitability, whether it's their brand, whether it's a technology which they own, whether it's sort of a distribution system which is better than others, or there has to be some moat which gives them the right to earn higher profitability, or sort of working capital intensity as well, whether if return on capital is driven for a company by running an extremely sort of negative working capital, and what drives that, what gives them the bargaining power against their suppliers and their customers, and whether that is sustainable or not. So if I find a business which generates a higher return on capital
Yeah.
employed, which is than its peers, and which I feel is sustainable. I like that business.
Okay.
Which so quality of franchise is that. And the third thing is um, I've spent my investing career is in investing in India and in Asia, and these are under-penetrated markets. So if I'm investing in those markets, I want growth in the company. So earnings or cash flow growth is important, and growth not just for the sake of it, but I believe that a sensible, sustainable growth has a lot of positive aspects in an organization's culture. It keeps them nimble, it keeps them competitive, people are driven, and it has a lot of positive aspects on the culture. If a company is not growing, people can get easily slip into being laid back and lethargic, and which destroys culture of that business over time. And sustainable growth is very important. If a company is sort of growing recklessly without having any cognizance of sort of what they are doing or how they are sort of drawing on natural capital and the cost of sort of natural capital, and which will sort of come and hit them in future, and they are not aware of it, the longer term headwind of ESG risks that they face, that is sort of not, that is in a way sort of not good quality management. That's not quality franchise, and it's sort of not sensible, sustainable growth which will come and hit.
I think they kind of interlink, I guess.
So management, franchise, sensible, sustainable growth at reasonable valuations. If I find these things in a company, I don't mind paying up even higher valuation in the short term if I believe in the long term. Company will grow into its valuations and will sort of do very well in the long term. So I'm happy to pay up if I find these things in a good quality business.
I guess I have two questions with regard to that, which sort of, I guess, are, perhaps just differences in the way different people think about it. But I think, eventually any good business as well might be run by somebody who is not a good manager. So, and at the same time, similarly, a business which has had good return on capital in the past and has grown sustainably in the past may not continue to do so in the future. So, you're taking history and projecting it into the future. So, number one, how would you think about that? And number two, how would you factor in, the fact that if management changes, management may not necessarily be good forever?
No, you're right. So on the first point, I'll give you an example of a company in India. So Colgate, India, which has a very strong franchise. Indian oral care market is under-penetrated. Only 70% penetration. Only 7% of Indians brush twice in a day. So there is, a lot of penetration growth to be had. Colgate has a dominant market share. It competes with companies like Hindustan Unilever, Dabur, which is an indigenous company, and several other companies. Unilever globally lost its focus on oral care a few years ago, and they sold their businesses across in many geographies. So which has led to Unilever losing market share over the last 15 years. Colgate's market share has gone from 40% to 55%, and it has kept on becoming more and more dominant. So I did start thinking that this is a franchise which can just run on itself, and it doesn't matter who runs the company. But now when I look back over the last 5-7 years, what has happened is, in the last 10 years actually, or maybe 8 years, there have been 5 different CEOs in Colgate India. There's a listed subsidiary of Colgate in the US, and they appoint CEOs, and as it happens with MNCs, there is always sort of rotation going on internally. Someone goes to India and then it's promoted somewhere else, etc. And that's what happened with sort of Colgate India, and they have, because these CEOs who were coming in for a very short period of time, they were sort of not thinking about sort of longer term risks, it seems, and they allowed the competition, the existing competition, and new players which got into the market sort of on herbal platform or naturals platform, just took the market share away from Colgate. And over the last 2-3 years, they've been just sort of trying to fight back against this new competition by way of cutting prices, by spending more on advertising, etc., which has hit their margins, and the growth has also become sort of a little questionable. And I think the business has been sort of mismanaged, and this was a franchise which seemed like it could run on its own. So I don't think that is true. It can be true for some time, but it cannot be true for a long period of time. And your second question was on return on capital employed.
Or sort of not return on capital employed, but you're taking the past and trying to project the future. So I think the two are sort of...
No, it's not. It's sort of trying to understand if it's sustainable or not. And then we don't stop there. I spend all my time sort of meeting companies. I meet more than 450 companies in a year, in India and in the region in Asia. And in these meetings, sort of what we are trying to do always is if it's a new idea, trying to establish whether something is investable or not. By doing work before the meeting and after the meeting as well. But also if it's something, an existing position, we're always sort of testing our conviction on the quality of management and the quality of franchise as well. So it's just sort of, I believe in investing in sort of traveling rather than arriving. And it's a sort of a conviction which sort of keeps on increasing in a business. Or sometimes it decreases and then increases again. So I prefer to just travel in that conviction journey and sort of tinker my positions in the portfolio accordingly. So in all these meetings, I'm testing that return on capital all the time, whether it's sustainable or not. So it's not just looking at the history and sitting on it.
So, with the traveling not arriving, I think, so how would you said that you would alter positions slightly as you go along, depending on how your conviction is changing and how things are going. But I guess there's a fine balance between when things are going badly to get more aggressive, and then at a certain point you also have to know, or be willing to say that actually maybe I was wrong. So how do you strike that fine balance between being more aggressive and throwing in the towel?
Which is why it is sort of absolutely important to have conviction on people that you're backing. If something goes wrong with the business, and there can be a variety of reasons why things can go wrong for them. It could be macro issues, it could also be sort of company specific issues. But if you have the conviction on the owners and in the management team, and they have demonstrated in the past that they can come through that period, that difficult period, as a winner, with a higher market share and with a sort of higher return on capital, it is easier to be more aggressive. It is easier to have that conviction when you have a long track record of companies, where you have been invested for some time. It is easier to have that conviction in simple, predictable businesses. And it's harder if the businesses are difficult to understand and not predictable enough, or where the track record is not that long. I have found that I have made mistakes in my judgment on sort of quality of people, and sometimes often the quality of franchise as well, where the conviction is not there and things go wrong. So I can again sort of give you examples of this. First, on sort of if you think of say, consumer business in India, Nestle India, where they import some raw materials, they also sort of pay royalty to the parent, which is in sort of foreign currency. And Indian currency over the last 45, 50 years has always been a weak currency. The Indian rupee has lost 90% of its value in the last 45 years. More than 50% in the last 20 odd years. So that affects Nestle's sort of costs. But if you look at its track record over the last 20 years, it may sort of struggle for a bit, but because they operate in underpenetrated categories and they have dominant market shares, they're able to sort of pass it on, albeit with a lag. In these 20 years, when the rupee has gone against them, the operating margins have actually gone up from 12% to 20%.
Oh wow!
And in dollar terms, the share price is up 16 times in these 20 years in dollar terms, and rupee has fallen a lot. So they have demonstrated that they are able to sort of, work through that that sort of macro risk that they face. On the other hand, Indian pharmaceutical companies, which have been a mistake for me in the last sort of 2-3 years, I have realized that I don't have enough conviction in those companies, and the reasons for that is sort of these businesses are very hard to understand. They are not simple. They are not predictable. And I have realized that people who run those businesses, even they don't know what they're doing. They're throwing darts. Sometimes they'll hit and sometimes they won't. And it is a very volatile business which is trading on very expensive valuations. And people are extrapolating the last sort of 10 years of their success into future, which is not going to happen, I think. If you want, I can talk more in detail on that. But
no, so actually what I was thinking is, I guess we didn't go into depth on it earlier, but with sort of sticking down on the management side of it, so, you've talked a lot about how you need to have management you can trust and how, for example, with Colgate India, management made all the difference, right? Or, even in the most recent example with the pharmaceutical companies in India where management doesn't know what they're doing and that results in problems. So how exactly do you make that judgment call as to whether you do trust management or not?
So when I start looking at a new idea, I start with sort of reading the chairman's or the CEO's letters at the annual report. And sort of last 5 years, 10 years or even longer. And I think that tells you a lot about what the company is about. If they are being honest with the challenges that they face, if they are being honest about the mistakes that they have made and how they are trying to change things, and then you can see that if they have been consistent or not, and if they have delivered on what they promised or not, that goes a long way in sort of in just my own conviction in a certain management team. And then I spend, as I was saying earlier, I spend all my time meeting management teams. And when I go to their offices to meet these guys, everything in their office tells you something about the management quality or the culture that the business is trying to build. From a Ferrari in the car park of a $100 million market cap company tells you something. If you go to the reception or the staff canteen or the toilet or the CEO's office, if he has pictures on the wall with sort of film actors and politicians, on his desk if there's a yacht magazine and sort of property in exotic locations, or the watch that it tells you something about them. And also sort of over years in discussions that we have with these management teams on a range of issues, on sort of how do they think about board composition, how do they think about sort of independent directors who are on the board, remuneration, succession, sort of longer term, what is remuneration based on, and what I'm always trying to sort of assess is what drives people to work every day and what are they trying to achieve in the long term, and whether I can feel aligned
with that
to that or not. And that's I don't know if I'm answering your question, but it's
My,
just sort of a
it
lot
was,
of things which go
yeah.
into.
My question was slightly more that, it's a value judgment, right? And I guess particularly if somebody is starting out making that value judgment, you're gonna keep getting it wrong. So how do you get to that point where you can feel comfortable saying that my opinion on the person is right? Because you will interact with the person on perhaps multiple occasions, have multiple meetings, but you don't actually sort of know the other person. So how do you get to the point where you can feel comfortable saying that my opinion or my sort of understanding of the other person is probably most likely right?
Yeah, that's very hard. That's also sort of, then you're saying, how do you arrive? And I'm saying I don't know.
Okay.
So I prefer to travel than to arrive. Um, um, but eliminating sort of poor quality management teams is easier.
Than identifying.
And there is no, I believe there is no perfect franchise or perfect management team. It's shades of grey.
Yeah.
And it's sort of, in those shades of grey, one has to be comfortable in that spectrum as to what is acceptable to you and what is not acceptable to you. It's an individual choice as well. Maybe it comes to you over time, and for a beginner it is probably
hard.
A little harder, but it's not that hard as well. Sort of my advice to sort of younger people in the team when they join us, I always tell them that you have to back your instinct. Don't take it lightly. There's a reason why.
You have a gut feel.
If you have a gut feel about a person, sort of, don't be shy to spell that out in your note or talk about it.
Yeah.
And you get it wrong, and sometimes you get it right, but over time you will know, where you're going wrong.
I think, with getting rid of the bad ones, there are obviously those who are sort of so skilled at being salespeople that you can't tell that they're bad. So how do you sort of see through a facade if that's being presented to you?
Look for inconsistencies, I would say. So for example, if you look at this company called JSW Steel in India, which I think has sort of poor corporate governance practices. And they publish one of the fattest sustainability reports. And you can get all sorts of data in that, which a lot of other companies don't publish. But if you read the CEO's letter, and you can go back and read it for the last 10 years, in none of his letters, not even a single word, he's ever mentioned about any of the ESG risks that the business faces, and it's a steel industry, and that they face a lot of issues. He doesn't talk about it at all in his letter, and they produce the sustainability report. I don't buy that. So in my view, that is a bit of greenwash. Whereas, a lot of other companies, even when integrated report was not a requirement, if you read the letters of the top management team of those companies in their annual report, when they talk about their business, you can see that the mindset, in their mindset, the sustainability issues are integrated in how they think about the business. And that's an approach to risk which I find acceptable, or at least aligned to. So sort of, I think it's about looking for inconsistencies. I was in India once and met this company, where the CEO was wearing the same uniform as the factory workers. And that meeting, as you said, it was sort of a 2-hour meeting. He said absolutely the right things that we want to hear. He was a fantastic sales guy. And then we went for a lunch in the staff canteen with all the sort of workers. But when we went for coffee after the lunch, there were different color coffee mugs based on designations.
Oh, wow.
A blue cup for vice president, a green cup for senior vice president, etc. What are you talking about? So looking for those inconsistencies. Directors, a separate directors elevator and elevator for sort of normal employees. It just tells you something where they're not being honest.
So sort of the last thing to do with how you think about companies, you sort of mentioned the risk faced by a company itself, but you know there are risks when you're sort of making a bet on a company. You are taking a risk as well, right? So how do you think about the risk that you take when you make an investment decision?
I don't think of it as a bet,
Okay.
first of all. Um, it's I see myself as a long-term partner when I'm investing in the company,
Mhm.
and there are sort of lots of responsibilities that come with it as a shareholder, and it's not just and we sort of take it very seriously to engage with the management teams and the boards of our companies on issues that we think are important from long-term perspective, um, and help, or if help is the wrong word, or at least sort of try to nudge them to do what we believe is the right thing for the long term. And I think, in the companies that we have invested over the long term, they see us as long-term partners now, and we have earned the right over the years to sort of sit across the table with these management teams in our markets to sort of have a meaningful conversation about the longer term issues in these businesses. Um, the, you mentioned how do we think about risk. The way we define risk is the risk of losing money.
So is that the risk of losing some money or
risk of losing any
Okay.
money? We don't think of risk as a risk of sort of underperforming any index or whatever. So relative performance is of no importance to us. Capital preservation is the first principle that we work on, and we don't want to lose money for our clients. What was your question?
My question was sort of, how do you, when you're making an investment decision, there are risks involved, right? So how do you think about those risks?
Mm-hmm. So there's always a risk. So it's about sort of risk and reward as well.
Yeah.
And then I express that risk reward in the weighting
Okay.
of individual positions in my portfolio as well. And what does that sort of weighting depend on? A number of reasons, a number of things. On what kind of industry a business is in. If it's a simple, predictable business like a consumer business in India, I can have a large position in it. If it is a more riskier business, like a property business, which is more cyclical and is usually leveraged and sort of struggles when the macro conditions are against them, they don't have their entire destiny in their hands, and they're sort of the seller when things go against them. I wouldn't have a very large position in a property company in the portfolio. If a business is cheaply valued, it's much easier to have a larger position in that as compared to a business which is trading on more expensive valuations. If I have had a long history with the management of the company, or I've been invested in it for a long time, and my conviction is quite high, then it's easy to have a bigger position in that. And if it's a new company that I've got bought into, as I was saying earlier, travel then arrive. It's almost very, very rare for me to sort of find a new idea and go 5% position in it. It is usually sort of very gradual as I build conviction on it, and it remains a small position. It's sort of a risk reward equation which has a lot of sort of variables which I just mentioned, and obviously with the basic premise of sort of not losing money.
Okay, so let's move on from sort of how you think about investing to questions which are perhaps more specific to your investing career. So Could you share perhaps sort of some of the sort of qualities you have which have either benefited you or made it slightly more difficult for you to be a good investor?
That's a very good question. um, I can talk about, I don't know what my strengths are. I can talk about the weaknesses that I've had and the mistakes that I have made in my investing career. And where, you know, I always tell myself that I should not buy something immediately after a good meeting with a company. And I've often made mistakes with that. Sort of, you meet a company management. Obviously, you've done some work before that, and you like your, you know, meeting the senior management, and you get very excited about the opportunity, the valuation is cheap, and you go and buy it immediately after the meeting. Usually, those are wrong decisions.
Okay.
You know, I've tried to. I rarely do it anymore. I stop myself from sort of buying something that early. It's usually better to just sleep over it for some time, and then do more work. Even when you know, just take more time thinking about it before buying something. Maybe I'm sort of, I'm happier to pay sort of higher valuations for if I find sort of qualities that I look for in a business, if I find that. And maybe, you know, sort of that is a mistake. So the way I think about valuations is slightly, you know, different. I believe that value has no meaning if there is no growth, or you know, if the business is not becoming, is not generating more cash flow every year. So maybe you know, that could be a mistake of focusing a lot on growth.
So
Well, another mistake which sort of I do make is that it is very difficult to distinguish between sort of, there are good quality and capable people, and then there are good quality and incapable people, and then bad quality capable and bad quality incapable. So bad quality incapable is easy. Bad quality capable is we will not invest in, but they go on and do very well. But we are happy to miss those ideas. We don't care because we don't care about the relative thing. But it's the good quality people who are incapable is where I have made mistakes in the past, and where I think we as a team sort of struggle the most, because we give them longer rope, and we are more sort of acceptable, we are more accepting of their mistakes for a longer period of time, and then we just hang on with those companies, thinking that, you know, that they will eventually get it right because it's sort of such good quality people. And I you know, I can talk about examples, so that you know, that I make mistakes with that as well.
So, you know, with sort of how do you try to avoid the mistakes? You know, when you're in the investment process, you described how you avoid the mistake of being impulsive. You know, you just sleep over it and you take your time to think about the company. But sort of, you know, there are so many biases as well which come into investing. So how would you avoid, as a collective group, both, you know, some of the mistakes you think you are more likely to make, and some of the biases which come into play when you're thinking about a company or when you're making an investment decision?
I think individually, so just sort of one person, memory is very important to be a good investor, I think. So it's very important to remember things that went wrong and why did they go wrong. it's very important, I think, to document your thoughts on a company after a meeting, or also sort of whatever research you're doing on a company, and to sort of store it somewhere. I think it is important to build a culture of humility in your investment team, and to sort of know that you don't know enough, which makes you open-minded, and to accept a different point of view, and also to inculcate a sort of a culture of people challenging each other or debating with each other on any investment idea, on sort of a range of issues, where people are always flagging
Yeah.
things that can go wrong, to the analyst who may have come up with a new idea. And I think that sort of creating that robust sort of process with that culture is very important, which helps in avoiding mistakes over time.
So I guess that sort of brings to a close what, how you would think about a company, what mistakes you as a person are more likely to make, and then how you can, as a group particularly, try to avoid the mistakes you would make, or anybody could make as an investor. So I guess to finish, I would like to ask you what you think somebody like me, who is, a 15, 16, 17-year-old interested in investing, could do to sort of develop that interest further, and I guess learn how to think about a company, how to think about investing.
I think read annual reports, and sort of, you don't, and try to think differently about companies. There are, for every, let's just sort of pick a number. There are thousands of analysts who are trying to sort of beat each other on the spreadsheet, trying to get their numbers right to the last decimal place. I don't see the merit of sort of trying to better them and spending a lot of hours on sort of trying to get your forecast better than others. Instead of that, I think one should sort of focus on things that most people are not looking at. Everyone builds a sort of a model on profit and loss of balance sheet or cash flows, but there are lots of things in the annual report which people don't focus on, and which tells you about the quality of the management and the franchise both, and which those numbers sort of miss.
Yeah.
And most people don't care about it. So I would say that sort of read a lot. Reading annual reports is a good habit. Write down your thoughts. Try to remember. Having, as I said, memory is very important.
Yeah.
And try to sort of think differently instead of just following what everyone else is doing.
So I was just watching bits and pieces of my interview with Vinay, and I think two things really stood out to me, or for me. I think the first thing that I find intriguing is his focus on the quality of management. I guess it sounds very obvious after it's been stated, but a good quality management, or a good, somebody you can trust, is really important, because that person is basically being given your money to manage it. And yeah, and then the second thing which I find really, really interesting is, so, Vinay says that conviction is about traveling, not arriving. And I think that's quite interesting, because it's particularly where you tend to be contrarian. In investing, you have to be contrarian. You have to be very careful between being contrarian and having your conviction increase as things keep going wrong, but also being willing to say, you know what, maybe there's something I don't know. And I think that's something which came up in my interview with Vinod Nair as well. You know, Vinod said there's a fine balance between being aggressive and having your conviction go up as the price is going down, and then being willing to throw in the towel when you sort of feel like maybe there's something you're missing, because often the market is just right. So yeah, I think those two things really stood out to me. On a sort of more technical note, I guess I would like to apologize for the poor video quality, but I think I found the content very interesting, and I hope you found the content useful and insightful.